From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for December 6th, 2024. Let's check the calendar. Well, the Packers last night played in Detroit, and the Pack came up a little short, 34-31. Now they're off until the 15th for another night game in Seattle. Your Milwaukee Bucks are also road warriors. They're on the road until the 21st of the month. The Milwaukee Rep is at the Stackner Cabaret. They're doing Lumberjacks in Love. If flannel is your thing, this is the show for you. And the Tosa Holiday Market is happening this weekend on Harwood Avenue. Well, we have a theme this week. It's alcohol. Let's start with Milwaukee's own Miller Brewery. Just in time for Christmas, they're producing a cologne that smells like a dive bar. Whenever I walk into a dive bar today, the aroma takes me right back to the 70s. You knew it was a good dive bar when you purposely didn't wear your good shoes. Miller is calling it Dive Bar Fume, and it's going to be huge. When you don't know what to get that special someone for Christmas, who you never want to see again, Dive Bar Fume. Let's showcase a senior housing complex in the Netherlands. They have royally ticked off their residents by banning alcohol. The management says it's for the residents' own health. Well, the residents don't like being treated like children, so they've taken to smuggling booze into the joint. You don't live to be 80, 90, 100 years old by listening to other people who know what's good for you. And finally, a man who had allegedly been overserved drove his Ferrari into the Pacific Ocean in Northern California. The Marin County Sheriff said the driver failed to properly negotiate a curve before sailing into the ocean. Kind of poetic. Just to follow up, the driver survived, but tragically the car didn't. On the podcast today, we have John Sandstrom, Kendall Bauer, Joel Driesing, and wrapping up the week, here's Kyle Titting.
Well, thanks, Max. All right week overall for markets. A bit of a mixed week, though. The NASDAQ up 3.3%, up 642 points this week. The S&P 500 added 58, that's 1%. And the Dow Jones Industrial Average actually lost 268 points on the week, down 123 Friday to close at the bell on Friday at 44,643, down 0.6% for the year. The NASDAQ up 33%, including dividends. The S&P 500 29, and the Dow Jones Industrial Average still a pretty robust 20.2%. You know, I think, Kendall, the time of year in which we tend to have a lot of conversations about putting a cap on the year so far, certainly on the heels of what was a better November, really capped by a single week of pretty strong runs early on. But, you know, what kinds of questions are you getting? What kinds of things are you telling clients with a full 11 months and a week now in the books?
Yeah, I think, well, certainly couldn't be happier with performance year to date. In the same vein, I've been kind of cautioning folks, hey, it's reaching that state of euphoria, right? We've had now 2 back-to-back years of phenomenal returns. So we know, hey, we're probably due for a pullback, not to spoil the fun here, but I think to be a little prudent, worth revisiting the portfolio. You know, making sure your stock allocation is in line with your goals. I think now is as good time as any to be taking maybe some gains from some of those stocks for things like RMDs, if you're one of those people that's waiting, you know, till the latter part of the year to satisfy those, to do any charitable gifting. But yeah, I think thrilled so far.
John, I think, you know, one of the benefits that I've seen from this year's returns, and especially on a rolling one-year basis, is that it hasn't strictly come from stocks. And especially as we look ahead, you know, even if what Kendall's saying about potentially seeing a little bit more of a reversion to the mean, even if it's not the correction in stocks, but if it's just slower growth going forward, well, maybe perhaps one of the benefits is that some of the rest of our portfolio might participate a little more.
Looking at bonds, especially this year, we've kind of seen them get back to a point where they're behaving the way that we expect them to, which is really what the 60-40 kind of portfolio is all about. using bonds as a defense mechanism. Stocks go on a massive run, they're going to be kind of your steady Eddie, but if they have a massive pullback, you're expecting those positions to kind of hold your portfolio strong and have that place to kind of pull from when you need to.
Yeah, we talk about the importance of balance, obviously, and I think so important that, maybe if that pullback is what we expect, or even, again, as I said, just maybe a slower return going forward, well, I think the fact that bonds are yielding, the 10-year Treasury as of the close of the week was yielding 4.15%. That's a pretty attractive rate. And that's for something that we would otherwise consider to be pretty free from, price risk over the next 10 years. Of course, Kendall, there's plenty of investments out there promising a lot more. And we got a pretty good reminder this week from one of our favorite Wall Street Journal writers talking about why sometimes if it sounds too good to be true, maybe it is.
Yeah, unfortunately, this is becoming all too common in the last decade. I would say Jason Zweig, who I would say arguably the best financial writer out there right now, did a couple of great pieces in the Wall Street Journal about, unfortunately, a couple that was not alone, but duped into moving money into a firm chasing, what was being offered and advertised to them as a guaranteed return, north of 15%. And unfortunately, there's bad actors out there that are going to do this. And, I think it's just an important reminder. I'm not going to dive too deep into the article itself. I encourage anybody to go and read it for the full story. But the idea or the takeaway is that there's no such thing as a free lunch. And if something seems too good to be true, chances are it is. And some of that, I think we start to get in this mindset, especially now, 2 phenomenal years in markets where all of a sudden we begin to expect these types of returns, right? We expect stocks to return 20% a year when we know, hey, that's not the case long term, right? So just be on the lookout. I think important to have these conversations. If you see something that say, hey, I heard about this or this looks great, call your advisor. That's what we're here for. We're happy to take a look at stuff, give you our opinion on it. But when you see things like guaranteed and double-digit returns, it should be a warning sign. I'd say.
And my understanding, Kendall, was that Jason Zweig actually saw ads for this stuff promoted online.
Yeah.
And was like, wait, what? They're guaranteeing stuff, and they're not allowed to do that, and because he knows, and started investigating, and now the federal authorities are actually investigating the same company. Yeah.
I think it comes back to, for us, the importance of education, right? The importance that not only do we understand what it is we're investing in and do our best to kind of navigate what those risks are, but that it's important that the end investor, that you as our clients, have an understanding of what it is we're doing and why. And yeah, you might not understand the nuance or the weeds of how a credit default swap works, or why we might use a particular treasury swap or some structure that's really out there. It's not the core of the products that we're using when we're talking about what are largely mutual funds and exchange traded funds that we invest in. And I think the more esoteric you get, and I use that word intentionally because it is a little in the weeds, but the more muddy the conversation becomes on what's actually in those underlying investment products, the more difficult it is for you to understand how they work, the more likely it is that when something goes wrong, it's not going to go a little wrong, it's going to go a lot wrong, because my guess is if I don't understand it, if you don't understand it, there's probably a lot more people that don't understand the risk either. And so it is why at our core we're educators. It's why at our core we want to make sure that we understand what we're doing and can communicate it clearly in a way that our investors understand, even those investors that maybe don't view themselves as the pros, as the experts. Time of year in which education is key. We get a lot of articles, John, on why we should do Roth conversions and why, coming through the end of the year, you're missing out if you're not taking advantage of this wonderful opportunity to move money from your IRA and move it into this Roth IRA in which you're never going to owe tax ever again, forgetting, of course, maybe some of the drawbacks of that conversation, forgetting, of course, maybe some of the reasons why you hear that. I'm sure you've seen some of those articles recently. What's kind of your take on, why it's out there and why it might not make sense for everybody?
Well, first off, I think that it's important just to kind of look at this situation as it's not a one-size-fits-all. It's going to be different on every single case. It might make sense for you, it might not make sense for you. But I mean, there are plenty of benefits to the Roth conversions if it makes sense for you from a tax perspective. It's the difference of, should we convert now because our tax situation will be better in the future for those distributions coming from the Roth later down the road? Are we going to be paying less tax now than we will in retirement? There's all sorts of different questions that you need to be looking at when you're considering these things. And it's also important to look at who is telling you that you should be doing the Roth conversions. Is it another advisor telling you that you should be doing Roth conversions and your current advisor is not helping you out as much as they possibly can? Or is it a journalist who's trying to push some type of a article just to get some clicks? But it really is a case-by-case basis, and it's a lot of different questions go into that calculation.
I took a lot of sales marketing classes in my understudy because it was an area that I felt like you learned a lot of that nuance, right, of what's the actual product being sold here and who's it being sold to. And I think sometimes we forget that we're often the product being sold for those financial news articles. What they're doing is trying to get clicks. And how do they get the clicks? Well, they tell you that you should be doing this thing that you're not doing, so you'll read the article so that they can sell a higher dollar ad because they got more people clicking on their article. And I think it's a reminder that the headline, you're missing this opportunity if you're not doing this, might just simply be to get you to read an article on something that maybe otherwise wouldn't apply to you and maybe you otherwise wouldn't click on. And of course, you hit the nail on the head. This is not a one-size-fits-all thing. It very much is in the weeds on what's your current tax situation and where are you headed. And that often involves not just a conversation with your advisor, but a conversation with your tax preparer, some very clear conversations on how we plan for things like retirement spending. And that's not as simple as something that a 1,500 or 2,000 word article is going to cover. It really does take more holistic approach, a more nuanced approach that's designed or tailored to the individual.
And Kyle, part of that gets to media literacy too, of knowing where the source of what you're reading is coming from. There are some legitimate financial websites out there. I'll actually mention one, MarketWise will have articles on there that are written by advisors, but they're written by people who are trying to sell services, and they're not necessarily journalists who are paid, to be objective or to try to look at things, outside of their interests. So just be careful when you're reading stuff to see that you know where it's coming from.
Yeah, and I think too, as much as the IRA to Roth conversion gets praised, nobody tends to bring up the downside risk to some of these. So things you got to consider. Conversion's going to add ordinary income from a tax perspective. You got to make sure you have cash on the sideline to pay the taxes for the conversion, right? Because the last thing you want to do is double dip into that IRA to use that money to pay taxes on the conversion, because then you start to interrupt compound interest, right? And so these are a couple of things too that I feel like oftentimes get overshadowed a bit. The other one too is the 5-year rule. And correct me if I'm wrong, but I think you convert assets from an IRA to a Roth, you got to wait 5 years to touch that money. Now, if you do that right before you retire, right, you don't think these things through, you don't ask these questions, you could shoot yourself in the foot doing something like that. So John hit the nail on the head. It isn't a one-size-fits-all, and it's not to disparage. I think there's plenty of situations where IRA conversions to Roths make a ton of sense, but you got to do that homework up front. Make sure that it makes sense for you and not just take blanket advice.
Kendall, it gets back to what you were saying, we were all saying before, is you have to have, it's nice to have somebody in your corner that you can trust to sort of run it by and say, does this make sense for me? And my circumstances, and I trust your background and what your interests are. And I said market-wise, I meant market watch. Yeah.
I would add to the conversation here that one of the reasons why this comes up this time of year is because it's when we're already talking about all the other pieces of the tax conversation. And when we tend to have the best possible picture we can have for what the year is going to look like, you really can't just say, hey, I'm going to do this conversion. You got to back into it. And that requires understanding what other sources of income you have for the year, including, Kendall, a pretty big one for us this time of year in capital gains distributions. A lot of potential nuance over the next couple of weeks as we look out to, especially in a year that was as strong as it was, some of our stock mutual funds may be paying larger than normal capital gains.
Yeah, I would say kind of get in the mindset of preparing to see some pretty big capital gains this year. It's not a shocker with how well things have gone. Some of these fund managers, they've run out of losses to kind of offset some of these gains. A lot of that was used up last year coming off the heels of 2022. And so, yeah, not shocking to see some fairly decent sized capital gains distributions. Remember, mutual funds by design have to pay, and Kyle, correct me if I'm out of line here, something like 98% of the gains onto shareholders. And so I often remind clients, hey, it's a good problem to have, right? People get upset because capital gains lead to more taxes, but it means you're making money. It means your funds are making money. And with a little planning, sometimes there's things we can do to minimize the impact. But yeah, I think ultimately expect higher capital gains this year, but remember that, it's a good thing, good problem to have, I should say.
And for those of you that log into your accounts regularly, a reminder that when that capital gain gets distributed from the mutual fund, so we'll take mutual fund X. Mutual fund X pays out a 10% capital gain. On the day it pays out that distribution, the share price is going to drop by 10%, right in line with what that capital gain distribution that was paid was. If you log into your account the next day, you're going to see that your mutual fund X went down 10%. Plus or minus whatever other market move there was, but you're going to see a big drop in the underlying share price, which leads to a big drop in the value of that investment. Of course, the second half of that is receiving the cash from that distribution, either adding it to your money market, adding it to your cash account, or reinvesting into more shares of mutual fund X. And so if, for example, the choice is to add that back to mutual fund X, well, now you've bought back the shares from the cash that was distributed, you've bought them back at the lower price. The end result is a value of your investment that would have otherwise stayed the same, but now you have more shares at the lower price. And the real challenge there is it doesn't happen in a day. It takes a couple of days for all of those transactions to settle out. That's perfectly normal, perfectly typical. But it can create some pretty significant potential nights of sleeplessness if you look at your account and see that distribution got paid out, but haven't seen it come back into the account yet. Know that if you own any kind of stock mutual fund, that's probably what you're seeing mid-December. They get paid out over the span of a few weeks, really from around the 5th until around Christmas, with the occasional early or late, but most of what you're going to see is coming out over the next couple of weeks. Joel, a decent amount of economic data this week, in particular a lot of news on the labor front. And signs, especially Friday, that a little stronger in the labor market than maybe what we otherwise thought.
Yeah, I wrote down strong with weaknesses. I mean, that's how I'm seeing the jobs report today. We've had 47 months in a row that employers have been adding jobs to the economy. This last month in November, it was above average, and that's a long time to be adding jobs without a break, and to be above average at this point is impressive. But there's some distortions in there. In recent months, we had 2 hurricanes and some labor unions who were striking, and you figure that in, and it evens out a little bit. There were a couple of things. So those job reports are basically 2 different surveys. One is looking at households and asking them, whether they're working and if they're not, what they're doing about it. And then the other one is looking at payroll data. And through both of those, I found encouraging things and watchful things. So, for instance, in the employment data report, bar and restaurant employees, which is a sign of, that's an industry where people have money and they're feeling a little bit freer about spending. They're more likely to go to bars and restaurants. It took a long time from the beginning of COVID for that employment group to recover, and it finally did at the end of last year. So there was more than 3 years that it took.
Instead of buying the Piggly Wiggly bourbon, now everybody's going out to the bar and maybe buying a little bit higher.
And it costs a little more that way because you're paying the servers at the bar to do that. But so that group, that employment group, is now 9 months in a row that it's been expanding. On the other hand, the number of temporary workers. And that's usually a sign of the trends in the economy. So when temporary help is rising, that's good, and when it's not, it's not. So compared to just before the pandemic, the number of temporary workers has been below where it was at the pre-pandemic level for 16 months in a row. So that's an ongoing thing. Long-term unemployment. So that's somebody who's not got a job. They're looking for a job, and they've been out of work for 27 weeks or more, so half a year or more. That's now above the pre-pandemic level for the last 16 months. On the other hand, the prime age participation of labor, the people between the ages of 25 and 54 who are either working or looking for a job, that's been above the pre-pandemic level for the last 21 months, so that's a good sign.
Yeah, pretty encouraging sign that those folks that should be in their working years either have the ability now to go look for work or are actively doing that. Maybe one of the reasons why we saw a little uptick in unemployment, even as the overall numbers were a little bit more positive. The one that really jumped out to me in our kind of economic indicators this week was the consumer sentiment number, a pretty big jump from the prior month, but also, I think some buried in there that suggests that maybe people are front loading some purchases right now with potential fears of maybe what's coming down the road with tariffs. Some signs that maybe people feel a little bit better overall about the economy as well, maybe a little more willing to spend, which might bode well, by the way, for what's one of the most important kind of seasons for consumer spending in our economy.
Right, yeah. I mean, a lot of these things all work together. I mean, if people are employed, if they see people around them who are employed or getting hired, they feel better about the economy and their own prospects. And yeah, I've seen other reports too that suggest that some people are not only feeling good about spending money now, but they're spending actually more money because they're thinking that the costs of especially durable goods might be going up in the future, so they better buy things now. And as we always mention, consumer spending is 70% of our economic growth. So those all factor into keeping the economy going.
Always anecdotal, but I've had a number of clients in my office telling me they're replacing appliances, they're buying a car, they're doing some bigger ticket purchases on the potential concern that maybe prices do go up a little bit next year if we see some tariffs. And, the one challenge with that conversation is if you increase demand because of a fear of future price increases, those future price increases tend to become the self-fulfilling prophecy. One of the big kind of inputs to price spikes is to overall demand. So raised demand, overall prices do tend to go up. We had some manufacturing and ISM data as well this week, and a lot of mixed signals there as well, perhaps, Joel.
Right, yeah, and all of that's going to sort out over time too, and especially manufacturing, because it involves things like overseas purchases and employment and things like that. But both factory order numbers from the Commerce Department and the Institute for Supply Management showed that manufacturing's weak, and it's not getting a whole lot stronger. Factory orders were up in October for the first time in 3 months, but they're only up 0.4% from a year ago, and that's not real strong. And the ISM numbers are showing that manufacturing as an industry has been contracting for 8 months in a row and for 24 months out of the last 25 months. So there's still some work to do there.
But still showing signs of overall economic growth, which I think is an important point to remember, that even when parts of our economy might be in contraction, sometimes for extended periods of time, manufacturing in particular, it doesn't necessarily signal that the overall economy is shrinking.
Right, yeah, it's like, we were talking about before with investors and investments, is that there are so many different variables, and I mean, you can't, it's hard to look at manufacturing just with a broad brush. There's a lot going on, and some parts are doing well and some others aren't.
Yeah, I think an important reminder too, right? The economy is not the economy of 30, 40 years ago, right? Where manufacturing was a huge part of that equation. I think it's, not maybe the force it once was. Not to say it's not relevant anymore, but I think sometimes we get lost in some of those old benchmarks, right? We joke sometimes about how a lot of folks will still peg to the Dow for a gauge of the markets, looking at 30 companies versus something like the S&P, which I would argue is probably the industry standard at this point when referencing general market, trends and health. So another piece there. But what I see looking at, some of this data, we have, a good jobs report, unemployment still well below long-term lows, pretty decent GDP number, wages outpacing inflation on a year-over-year basis.
But not by too much.
Not by too much.
Right,
so
yeah.
To me, it looks like the economy is, doing just fine, and I don't want to shoot myself in the foot, as we run into something down the road. But right, it's sometimes we grasp or we look for what's going to be the slowdown, and we did this in 2022, and it hasn't come yet. It will come someday, but from what I see, things look okay.
And I think if we're going to have a problem, my preference would be to have that problem coming out of an environment that's been fairly solid rather than coming through one that's otherwise been weak. And so, I think the solid foundation we've kind of built over the last couple of years for our economy is a good springboard to kind of what we need to see continue to happen, even if there's some bumps along the way. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.